The property tax bill was already open on the kitchen counter when he walked in from work. It had been there since morning, unfolded and flattened under a ceramic salt shaker, as if that small weight could keep it from expanding any further into the room. The house was quiet, except for the low hum of the refrigerator and the sound of the HVAC system cycling on, pushing air through vents that had seemed like a milestone the year they moved in. 17 years earlier, the purchase had felt measured and responsible. A fixed rate mortgage, 20% down, a neighborhood with stable schools and predictable resale value. The inspection report had been clean. The appraisal had matched the contract price. The monthly payment fit comfortably within two professional salaries that were both, at the time, steadily rising. Ownership replaced rent with structure. The check went to a lender instead of a landlord. Equity replaced the word expense. The closing table conversation had been calm, procedural, almost understated. Sign here, initial there, congratulations. The house itself had not changed much since then. Same driveway, same maple tree in the front yard, same fence along the back, replaced once after a windstorm. But the financial atmosphere around it had thickened. The first few years passed with manageable adjustments. Property taxes increased modestly. Homeowners insurance ticked upward after a regional storm season. The mortgage payment remained constant, predictable, anchored in the kind of stability that mid-career professionals build their lives around. Promotions came, raises accumulated. Retirement accounts grew in the background through payroll deductions that barely required attention. The house absorbed income quietly, not aggressively, just steadily. Then, maintenance began arriving not as isolated events, but as sequences. The roof at year 12. The water heater 2 winters later. HVAC repairs that were small individually but frequent enough to become an expected line item. Landscaping, repainting, a cracked section of driveway that required resurfacing. None of it dramatic, all of it normal. Each project was paid for responsibly. Cash reserves were used first. A short-term home equity line was opened once and paid down within a year. Credit remained excellent. Net worth on paper continued to rise, supported by both retirement balances and increasing property value. The balance sheet looked strong, but liquidity narrowed. Cash once held in high-yield savings accounts began to feel allocated before it was even earned. Bonuses that had once flowed toward brokerage accounts instead settled into home projects already scheduled months in advance. A bedroom renovation justified by long-term value. Energy-efficient windows framed as cost-saving improvements. Exterior paint selected in neutral tones to protect resale appeal, even though selling was not being discussed. At work, compensation remained solid. Two stable careers. Employer-sponsored health insurance. 401k matches captured automatically. Annual raises that kept pace with cost of living adjustments, sometimes slightly ahead. Yet, the sense of financial flexibility had quietly shifted. There was a time when an unexpected expense felt inconvenient but manageable. Now it required sequencing. If the furnace failed this winter, the brokerage contribution would pause. If the car required replacement, the kitchen update would be deferred. If one income paused even briefly, reserves would thin faster than anticipated. The house itself was not in financial distress. The mortgage balance had fallen substantially. Equity had grown through both principal reduction and appreciation. Online property estimates suggested substantial unrealized gains. Neighbors who had sold recently had done so at prices well above what anyone would have predicted at purchase. On paper, the home was performing, but equity did not pay the tax bill sitting on the counter. Annual property taxes had nearly doubled since purchase, not in a single year, but gradually, in increments small enough to feel reasonable each time. Local assessments adjusted, school levies passed, municipal improvements were funded. Insurance premiums reflected broader regional risk models. The mortgage payment had stayed fixed. Everything else around it had not. There was no crisis, no delinquency, no late notices. Every bill had always been paid in full. The checking account never dipped below a carefully monitored floor. Credit utilization remained low. Retirement contributions continued uninterrupted. What had changed was the ratio between visible wealth and usable cash. Net worth statements showed growth. Retirement accounts, home value, brokerage balances, each line trending upward over the long arc of 2 decades. But the checking account, the emergency fund, the immediate liquidity buffer required to absorb life's variability had narrowed relative to total assets. The house required annual funding simply to remain itself. Taxes, insurance, utilities scaled to square footage, maintenance, repairs that were neither upgrades nor improvements, just preservation. Preservation carries a cost. The realization did not arrive dramatically. It surfaced gradually during routine budgeting sessions. Monthly transfers were adjusted. Savings allocations recalibrated. Contributions shifted by a few percentage points to maintain stability. Nothing extreme, just careful. There had been a time earlier in their careers when the majority of income felt discretionary after fixed expenses. Now fixed expenses dominated, even though income had grown. The children had aged into college discussions. Tuition projections entered the spreadsheet. One had already begun. Federal student aid paperwork was completed accurately and on time. A 529 plan provided partial coverage, built steadily over years. Still, annual tuition bills rivaled what the mortgage payment had once felt like at purchase. The house did not cause those expenses, but it occupied capital that might otherwise have buffered them. Selling was considered briefly one year when market values peaked. The equity gain was real. After transaction costs, there would have been a substantial sum available. But downsizing within the same metropolitan area offered limited financial relief. Smaller homes carried higher per square foot prices. Property taxes followed assessed value. Moving farther out would have meant longer commutes and new social adjustments. Staying felt rational. Liquidity continued to compress quietly. Work remained stable, but careers at this stage no longer carried the same upward trajectory as earlier years. Raises were incremental, promotions less frequent. Health insurance premiums through employers rose steadily, even as coverage narrowed in subtle ways. The house payment, once a marker of stability, had become a structural commitment that required consistent income to support. Vacations shortened, not eliminated, just reduced in scope. Larger discretionary purchases were evaluated through longer internal conversations. Brokerage contributions resumed when possible, but paused more often than before. Cash accumulated slowly, then was redirected toward another maintenance need. None of this appeared in public perception. The home remained well kept, the lawn maintained, the exterior clean. Neighbors likely assumed financial comfort based on longevity alone. Inside, the numbers were balanced carefully each month. At social gatherings, conversations occasionally turned toward early retirement or geographic relocation. Some peers discussed selling homes in high cost areas to capture appreciation and move to lower tax states. Others leveraged remote work flexibility to reduce housing expenses altogether. In this household, retirement accounts were healthy but not excessive. The home represented the largest asset by far. It anchored their net worth. It also anchored their required annual cash outflow. A subtle psychological shift accompanied the financial one. Risk tolerance narrowed. Career decisions were evaluated less for growth and more for stability. A lateral job opportunity that once might have seemed interesting was declined because it carried uncertain compensation for 2 years. The mortgage was manageable, but the total fixed cost of ownership required predictability. Ownership encouraged conservatism. There was no resentment toward the house. It had hosted holidays, graduations, ordinary dinners, and quiet evenings. It had provided stability during economic downturns. It had appreciated in value. It had done exactly what it was designed to do within the American asset framework. It simply required ongoing funding. As retirement age approached, projections shifted. The mortgage would be paid off within a few years. That milestone once carried an emotional charge. Now it appeared as a modest reduction in monthly outflow, partially offset by rising taxes and insurance. Even without a mortgage, the house would not be costless. The idea of accessing equity through a loan product surfaced in private conversations, but was never pursued. Borrowing against appreciation to restore liquidity felt like reversing earlier discipline. Yet the appreciation itself remained inaccessible without sale. Paper wealth, fixed asset. Liquidity remained the variable. During a market downturn 1 year, retirement balances dipped significantly. Contributions continued automatically. The house value also softened temporarily, according to neighborhood sales. For the first time in years, net worth statements did not trend upward. Cash reserves mattered more than valuations. It became clear that asset ownership had created a form of stability that required continuous income and constrained flexibility. Not dramatically, not urgently, just structurally. The property tax bill on the counter was paid that evening through the bank's online portal. Confirmation number received, balance reduced. A routine transaction in a long sequence of routine transactions that define middle income asset ownership in America. Nothing had gone wrong. The mortgage would eventually reach zero. Retirement accounts would likely continue to compound over time. The house would remain maintained and funded as long as income supported it. But the relationship between wealth and freedom had shifted in ways that were not obvious at the closing table 17 years earlier. The asset had grown, so had the obligation attached to keeping it. Liquidity narrowed, not because of mismanagement, but because ownership consolidated capital into a form that resisted quick conversion without disruption. Selling meant relocation. Borrowing meant leverage. Staying meant funding. Each option carried structure. In quiet moments, the house felt less like an achievement and more like infrastructure. Valuable, durable, but demanding steady input to remain functional. It provided shelter, continuity, and measurable net worth. It also required annual recommitment through taxes, insurance, utilities, and upkeep. No crisis, no regret, just recognition. The bill on the counter would be replaced next month by another envelope. The loan would need receding in spring. Insurance would renew in summer. Maintenance would continue on schedule. The house would stand as it always had, unchanged in appearance, steady from the street. Inside, the budget would continue adjusting around it.